Okay, thanks very much. Thank you. I think we're ready to start now. So if I just sort my screen out, can you just bear with me a second? I may lose my chat box. So thank you. Thank you very much. First of all, welcome to this very special webinar that FX Street have allowed me to give to you. It's a webinar I'm going to talk about my new book, as you can see here, Forex for Beginners. And as I said, I'm very grateful to FX Street for this opportunity to come and share some time with you to tell you a little bit about the book, why I've written it, who it's for, and hopefully to give you a little bit of insight as to the reason why I wrote the book in the first place. So there it is. It's Forex for Beginners, and exactly as it says on the title, what you need to know to get started and everything in between. Before I actually move to the book, in case some of you may not know who I am, this is me. My name is Anna Coulling. I've been around trading for almost 17 odd years. I started before the days of the internet. I actually trade in collaboration with my husband and partner David, and my association with FX Street goes back about 5 to 6 years, pretty much when they first started as well. I'm one of their contributors, as you can see. This is the front page of my revamped website, and here I put this together really for traders as a sort of resource. It's all freely available, and it's got a little bit of trader education on there. I write market analysis for FX Street and also some other internet portals as well. And this is where you can find out a little bit more about me. But I just want to tell you a little bit about where it all started. And this is where it all started. This is a boat called The President, and it's on the River Thames. As I said, 17 years ago, I came across an article in the Financial Times, and it was really one of those sorts of articles that sort of said, well, do you want to change your life? Do you want to have a complete change of career? If you're interested, come along to this presentation. And the presentation was on this very boat. And it's still there. This is a sort of party boat, and you can hire it out for all sorts of different events. And there must have been about 200 of us in this presentation. I didn't know what to expect. It was at the presentation. It was done by a man called Albert LeBoss, and he brought on all sorts of people to explain how the world of trading and investing was changing. It was now possible as a retail trader to take part in this exciting new world. You could you could secure your financial future, your financial freedom for you and your family. And we were so, my husband was with me at the time. We were so impressed that we literally signed up on the spot and handed over £10,000, which in those days is a lot of money now, but it was a lot of money, as I said, almost 17 years ago. Now, at that presentation, there was also a man there called Tom Williams. And for those of you who may know, Tom Williams has written a book in which he talks about using volume as an indicator for trading and investing. And this is how we were introduced to this fantastic new world. And you have to remember that at the time, there was no internet. So everything was done on the telephone manually. And in fact, we actually started with the FTSE futures. And for those of you who are experienced traders or have been around the markets, maybe not as long as I have, will know that starting in futures is probably the last market that you would want to get into as a complete newbie. And it was in the days literally where you had to pick up the telephone, place an order with the broker. The broker would then go to the floor of the exchange in order for you to get your fill. So it was very stressful. The trading itself wasn't stressful. What was stressful was the technology, because you never knew whether your data feed was going to be interrupted or whether your order was even you were going to be filled on your order. And since then, David and I have traded and invested in virtually every market. We've done stocks, we've done options, we've done futures, and we also trade commodities and now latterly spot Forex. as I said, going back to that original presentation when Albert introduced us to the concept of using volume with price, it isn't a new concept. It's one that's been around for a considerable time. In fact, I think there's even references back to Charles Dow himself, the man who started the Dow Jones Index, whose name is given to the Dow Jones Index. And these, if you like, are my own trading heroes. As you can see on the right-hand side, there's Jesse Livermore, the book that every trader and investor should read at least once, The Reminiscences of a Stock Operator. The one in the middle, some of you may know Richard Wyckoff and his book, Studies in Tape Reading. I actually have a lot of his original work, which I still refer to. And he too has done so much for traders and investors in trying to explain this incredible relationship between price and volume. And the one on the left, I think, is perhaps slightly not so well known. This is a guy called Richard Ney who had been a Hollywood actor, but then turned his hand to stock investing. I think he was a stock trader himself. He handled a lot of money for many of his contemporaries, a very, very wealthy man. And he took, in my opinion, he really took the concept of volume, price, insider manipulation, who was really driving the markets to another level. And you can still buy his books. They are all out of print. But if you can track them down on Amazon, they are really well worthwhile. And I can assure you, nothing has changed since the days of Livermore, going back even further to the days of W.D. Gann, going back to the days of Elliott, going back to the days of Charles Dow. The markets have not changed. What drives the market, i.e. people and their money, and drives it in, fear and greed in equal measure, it hasn't changed. What has changed beyond all recognition is the ability for all of us to participate in these markets. As I said, when I started, you needed a telephone, you needed a data feed, you needed a huge terminal, a satellite outside your house. Now all you need is literally a laptop and an internet connection. And you don't even need a laptop, as you know, you need a tablet and a mobile phone. And just to put it into context, these are my other two books. This is my third book, Forex for Beginners. I actually started with the three-dimensional approach to Forex trading. And the second book is The Complete Guide to Volume Price Analysis. Again, it just brings everything up to date. And if you like, I've done it slightly backwards. And as I say in the description to Forex for Beginners, it's really a prequel. I thought long and hard about whether to start with Forex for Beginners and then the other two books. But it's actually worked out a lot better because it's allowed me to put into the market, if you like, the philosophy, the concepts that have guided me and my husband for the last 17 years. But I'm absolutely thrilled and delighted that certainly Volume Price Analysis continues to be a number one bestseller, and the response we've had so far to Forex for Beginners is also very, very encouraging. And if any of you are listening if any of you are on this call today, I do want to thank you very, very much from the bottom of my heart. Right, Forex for Beginners. Why did I write this book? Who is it for? And what does it cover? Well, if I start with the last one first, what does it cover? It covers everything I think new traders need to know. It has all the basics in there. It will explain to you what a pip is, how currency pairs are quoted. There's a very big chapter on money management. There's a chapter on trading psychology. So I do try and cover, what I think is, if someone came to me and said, look, I'm interested in Forex, where do I start? I would be very confident in giving them this book. I would also probably refer them to something like, to the educational section at FX Street, just to sort of maybe if I've missed one or two things, but I pretty much cover that. Who is it for? It's for obviously new traders, but in all honesty, even if you've been trading for a little while, I think it's not a bad idea just to go back to the basics sometimes, just in case that you may have missed something. And in fact, thinking on what is in the book, one of the questions that we are always asked, David and I, was something on position sizing. And this is quite a hard topic to go and sort of research easily, certainly on the internet. And as part of the money management chapter, I mean, that chapter on its own, in some senses, could be a book on its own. It's something that can trip up not just new traders, but experienced traders. So it covers everything. Why did I write this book? I wrote this book for a number of reasons, but primarily I wrote the book because I can write the book. I have the experience, I have the knowledge, and I have the expertise. And together with my husband, we've really reached a stage in our life where we've kind of sort of done everything. We've achieved our, if you like, our financial and trading goals. And I know it may sound a bit cheesy to say, but there does come a point in your life, and all of you, I imagine lots of you out there, and you're all very young, and I'm probably old enough to be your mother, if not your grandmother. There does come a time when you do have to give something back, and you have to share, and you have to pass on to the next generation of traders and investors what you have learned, because this knowledge, it is to be shared. And if, from what I tell you and from what I write and what I explain to you, if it stops one person from losing money in this vicious business that we are in, and it is a vicious business, then I feel I have achieved my goal. That's partly why I did it. I also did it because for the last 5 to 6 years since we started on the internet and started putting out our market analysis, we have about 80 odd sites which are all free, lots of free resources. And the one question that we are always being asked is, when are you going to write a book? Please write a book, which is what we've done. And we've also deliberately kept the pricing of the book, certainly the Kindle books, as competitively as possible, because we want people to share this knowledge. You may not agree with what is in the book. You may not agree with my method. You may not agree with what I've written in the book. But at least you have the opportunity to learn what I have learned, and certainly not make the mistakes that I have made. You may make your own mistakes, but hopefully you'll only make half the mistakes that you would have done without the book. So that's the reason why we've done this book. But there is a difference about this book, in as much that, yes, it covers all the things you need to know on money management, why we have a Forex market, the kind of thing that you could say to me, yes, but, I could go to Investopedia, or I can go here and I can find that out. That is absolutely true. I still feel I would have to include it in a book called Forex for Beginners. But the difference about this book is that it introduces you to my own trading method, what I call the VPA method, which is volume, price, and analysis. And encompassed in that method, it is volume and price, but it also includes support and resistance, candles, candle patterns, because these tools, if you like, these indicators are the only indicators that will allow you to identify and analyze market behavior. As I said earlier, markets are driven by people and their money. In other words, they're driven in equal measure by fear and greed. And unless you are in the minds of each and every individual participating in the market, there is no way you can see whether a market is fearful or whether a market is greedy. But from our charts, we can deduce that. And in my opinion, in my humble opinion, this is the method that allows you, that gives you the most insight, the most clarity into market behavior, market condition. What the book also explains is what I call the multi-dimensional nature of the Forex market. Now, the Forex market is marketed as a very easy market, as a very simple market. And it is very easy and it is very simple to enter and to participate. But I can assure you it is far from simple. It has a complexity and it's like a spider's web, if you like, which belies its simplicity. And the reason for this is, once you understand the reasons, you begin to see the market in a completely different way, and you begin to understand why, when perhaps you are trading a particular pair or you're in a trade and suddenly the whole thing falls apart. And the best way I can describe this to you is this, if you like, this multidimensional nature of the Forex market. If you think about it in this way, this is the only market where you are trading a pair. Unlike the gold market, the silver market, the stock market, where you're looking at one instrument, you're looking at one product. In gold, you are just looking at market sentiment towards gold. Is it bullish? Is it bearish? Am I going to buy or am I going to sell? It's very straightforward. It's very linear. When you're looking at the Forex market, that's not the case. You're always looking to buy and sell against another currency. To go back to my gold example, you don't buy and sell gold against wheat. You don't buy and sell gold against palladium. You don't buy and sell gold against oil. You may consult these other instruments to see whether there's any correlation. And certainly, if you are trading oil, gold, and silver, I hope you're always looking at the dollar index or what the dollar is doing, simply because the commodities are priced in dollars. But this is not the nature of the Forex market. And there are two other reasons as well. First of all, you have the dollar. The dollar is, we all know, is the currency of first reserve. But the dollar also fulfills an equally important function in the Forex market, in that it provides liquidity. And by liquidity, I don't mean it's necessary, it is the biggest, it has the biggest share of the market. It functions in this way, and I'll give you this example, and it's not my example, it's an example that someone kindly provided for me. But imagine you are in Singapore and you want to buy something from South Africa. So you have Singapore dollars, and obviously in South Africa you have the South African rand. There is no direct exchange between the Singapore dollar and the South African rand. And even if there were, it wouldn't work. There are various reasons for that. So the way it functions is, if you're in Singapore, you would sell your Singapore dollars, you would buy US dollars, and with those US dollars, you would then use those to buy your products in South Africa. And these sort of cross relationships, of which, if you like, the dollar facilitates, happens all the time. This is what you are seeing on your screen. Yes, you are seeing trader sentiment, market sentiment towards the dollar or the Japanese yen, but you're actually seeing, real live exchanges for people who either want to buy or sell product. And someone asked me to describe this, and I sort of said, well, it's a bit like, the dollar is a bit like the jam in the sandwich. That is the function of the dollar. The dollar has other functions as well. It's a safe haven currency. That in itself is going to create demand. Once you realize what the Forex market is actually doing, you then begin to realize very quickly that it is not the simple, is it going up or is it going down? Yes, you want to profit from whether it's going up or it's going down, but you need to understand what is driving those currencies that are in a pair. So, for example, if you see a euro dollar going up, is it actually euro strength that is driving that up, or more likely because of dollar weakness? And the only way you can do that is you have to try and isolate the individual strength and weakness of an individual currency. And later on in the presentation, we'll actually see that there is a very, very quick way of being able to do that. But so that is what is in this book. This is what is different about this book. Yes, it covers all the basics for trading Forex, but there is this other dimension, this other element to the book. Moving on from what I said previously, we then have what I call a currency matrix. So not only, given the multi-dimensional nature of the Forex market, you have to try and isolate the individual strength and weakness. And you then have to go and see whether that strength and weakness, in what other pairs is it reflected. And in my book, I explain this I call it the currency matrix. What you then also have to do is then you take that a step further, and that is, and this is something that I think is absolutely key. It is key in all trading, but I think even more so in Forex because of the way the market is structured, and that is you have to learn to trade in multiple time frames. Because when we trade, we are actually taking on two risks. The first risk is very easy. It's the financial risk. It's basically, well, how much money am I going to stake on this particular trade? That is very easy to calculate. It's part of your money management, your position sizing, call it what, you pull up a calculator and away you go. The second risk of trading is very difficult to quantify and very difficult to assess, and that is the risk of the trade itself. So, for example, I'm considering taking a long position in a euro dollar in a 5-minute chart. What is the risk on this trade? Am I taking a low risk, a medium risk, or a high risk? Well, if you don't know what is driving the euro and the dollar at that particular moment, you're going to be exposing yourself to a higher risk. And by understanding what drives the Forex markets, by isolating individual currency strength and weakness, by using a currency matrix, by looking at trading in multiple time frames, this will help you reduce this second risk of trading. So that is also in the book. Now, we don't have a lot of time today, and I'm just going to see, because with this, is it okay? We're running okay. We've limited time today. So what I'm actually going to cover, there's lots of other things in the book, is I'm going to talk a little bit more about volume price analysis, what I actually mean by it, and also going to look at the currency matrix in more detail. And I'm actually going to do it. I've actually got some charts, some live charts ready for you. I've got some slides, and we'll look at that as we go along. I'm going to the next one. Volume price analysis. Price is just a price. It is a leading indicator. But if you only have a price on your chart, do you ever really know whether the price that you're seeing, either moving up or down or sideways, is the move valid? And I contend that no, you can't. It's just a price. That's all that's being reflected on the chart. And exactly the same with volume. Volume is a leading indicator. It's the market. It's what's happening at the live edge of the market. But on its own, it just tells you that there's volume, that there's lots of noise in the market. So individually, they're very predictive, they're very powerful, but they only give you one function individually. But when you add them together, this is where you get what I call volume price analysis, because volume validates price, price validates volume. If you like, it's what I call they are mutually interdependent. And by combining them in this way, you will know whether a move on a chart, as I said, is a valid move or it's an anomaly. Because you have to remember, the market is there to take your money. It's not there. It doesn't care whether you succeed. In fact, it hopes that you're going to fail. So it's constantly playing tricks with you. You've got the market makers, you've got the insiders, sometimes you've got dealers. There are all sorts of factors out there who are conspiring to part you from your money as soon as possible. So we're not going to go down the conspiracy theory. We know markets are manipulated. You only have to look at the recent headlines in the financial press to know that the regulators are shock horror. Oh dear, the Forex markets are manipulated. Well, why is that so strange? Why is everyone so surprised? We know. But what we can do by using price and volume, we can see that manipulation. We can see whether a price move is valid or not. And that's what is covered in the book and explains to you what you can do. Now, I'm sure the question's going to come up, and I'm sure the objections are going through your head. And I'm always asked this, and they say, but there's no volume in spot Forex. And you're absolutely right in the sense that there is no central exchange, so we never know what the size of the contracts are that are going through. But what we do have, excuse me a second, is we have tick. And we have tick volume, tick data, which registers a change in price. And to be perfectly honest, it's a good enough proxy, and in many ways it's actually better, because with the spot Forex market, you don't really care what the size of the contracts are or the sheer volume of currency that's being exchanged, because what we want to try and identify is whether the activity that is surrounding a certain price level, or you get price clusters, and we see lots of interest at that price cluster or not, and the price moves. What we want to do is we are constantly looking to validate a price move and profit from it. So tick data, in my opinion, is more than good enough. And as I said earlier, to volume price analysis, we have price, we have volume, we add our candlestick patterns, we add support and resistance, again, to point us, to not only do they leave footprints on the chart to tell us where price has been, but because of the patterns, because as humans we operate on pattern recognition, and we're all the same, and everybody is looking at the same chart. There is an element of a self-fulfilling prophecy, and once you begin to recognize those candlestick patterns together with price, together with volume, you're going to have a pretty good idea of where the price is going next. Volume price analysis, it works in all time frames. It works from it works from tick charts actually to month, and you apply it using multiple time frames, again, because we always want to try and reduce that second risk of trading, which is the risk of the trade itself. And again, this is volume price analysis. So the second thing we're going to talk about today is the currency matrix. What's unique about Forex? I've explained that earlier on. The currency matrix allows us to isolate individual currency strength and weakness. Forex is not a single instrument market, as I said. Unlike when you're trading gold, you don't trade gold against oil, you don't trade it against wheat, another commodity, you trade it individually. Well, and unless, of course, you're trading Forex futures, I do accept that. In the spot Forex market, you're always trading one currency against another. And what we need to try and establish, as far as is possible, in the pair that we're looking at, is whether we're looking, for example, the euro-dollar going up, is that really as a result of the euro strengthening, or is it more as a result of the dollar weakening? And this is where the currency matrix comes in. It allows you to identify overbought, oversold, in other words, which is strong, which is weak. And if you like, it's a simple solution to actually what is actually quite a complex problem. Now, I'm just going to bring this down a minute because for some reason it doesn't allow me to look at questions. So I'm just going to pull my charts up. There we are, MetaTrader. Here we are. Right, I can see we've had quite a few. Let's have a look. Okay, and also the time. Right, okay, do candle sizes show? Right, I'll just answer that now because we're talking about. No, it's not. It's not a question of candle related to volume. What we're looking at is, and I'll show this later on in the slides and also in the live market. What we're looking at is if you like, the size of the candle relative to the volume that is being displayed beneath the candle, whether the two are in harmony or whether there is an anomaly or some kind of divergence. That's what we're looking at. So I'm just going to go back to my presentation, and then I'll come up to the charts, because I think with something like this, it's always easier to, if you actually see what I've been saying in the live market. So I'm just going to go back to the presentation. Just bear with me a second. Right, here we are. And what I've done here, these are actually some screenshots from the book itself, because I wanted to, and it actually answers the question very neatly. And this, as you can see here, we're looking at a 15-minute chart of the Aussie yen. Got the volume indicator at the bottom, and that's all I've got. I haven't even got support and resistance on here. All I've got are candles, candle patterns, and the volume underneath. And if I just draw attention, as I said to you, what we're looking to do is we're looking for validation of the price or anomalies. And if I can just draw your attention to candle 1, which was a down candle, and you can see underneath there was a lot of activity under that candle. All the tick volume is just tells you that there were a lot of participants in there, and the chances are that it was a down candle. There was more selling in that candle. But look at candle 2. Now, a lot of traders would have gone short there because it's a big down bar, and you think, great, the price is reversing, and you've actually got a 2-bar reversal from the candle previously. But look at the candle which is highlighted as candle 2, and look at the volume underneath. Now, with volume and price, most people can understand that when a price rises or something goes up, you need effort, you need fuel, you need you need activity to make it rise. But you also need the same to push a price down. It's not gravity that pushes prices down. It's you need more selling than buying. So in a downtrend, you need more sellers than buyers. In an uptrend, you need more buyers than sellers. So therefore, if you look at candle 2, what have we got? Well, we've got a candle which is, and you look at the volume underneath it, the volume is as much as the previous candle, which was a widespread down candle. But the one next to it, you had as much activity, but it wasn't going anywhere. The price stopped. If you like, there was stopping volume. Buyers were coming into, to stop the move going further down. And that is what we call an anomaly. So by looking at the candle and the shape of the candle and looking at the volume pattern underneath, that is a warning signal. It's not an entry signal. It's simply a warning signal. It's simply telling us that the down move, which was precipitated in candle 1, something is happening. It is not going to continue. And in fact, this is exactly what happens, because the other notable thing about price is, yes, price goes up and down, but price spends an awful lot of time in congestion, moving sideways, either, deciding whether to go up or whether to go down, or it simply pauses. The market quietens down and it waits. Sometimes it's waiting for a piece of news. Sometimes it's waiting for, any other type of event. And this is what happens here. What happens again? The market moves sideways. It doesn't carry on falling. The price is supported. And then gradually, as you can see the little blue candles going up, you can see the volume then rising, and it goes. And so the price carries on up. But if you had thought that that was going to be a nice down move, the candle 2, together with the volume that was underneath it, would have been a big red flag to say, hey, listen, this is not a true move. This is what we call an anomaly. And in fact, this is the same chart a little bit further on in the session. You had the up move again, then it moved sideways, and look, candle 1 and candle 2. And these are 2 shooting star candles. You could even call them a pair of a tweezer top. What happened? If you look at the volume underneath candle 2, a huge amount of volume, activity. Let's call it activity, flow, lots and lots of interest. Was the could the price be supported? No, it kept falling back and back. That is another huge red flag to tell you this isn't going anywhere. It has one attempt to rise on the first shooting star. It was knocked back. The second one came, it tried to rise again. It was knocked back. Look at the volume. They could not push that price further up, and it then started down on a waterfall. And if you look at the 3 down candles, if you go back to the first down candle after candle 2, you see the volume underneath it here. It's relative. It reflects the move in that candle. But look at the next candle. Right, that goes down. That is rising volume. What is that telling you? It tells you there's some momentum behind that move. Now, the screenshot was taken before before it carried on. We just stopped it because I wanted to take. It was such a great example. But you have a down move and you have rising volume. That's good. That tells you that is a genuine move. And I just want to whiz through. Here we are. In fact, it's a continuation of the same one. And we got the little move down in this little waterfall. Again, rising volume on the third candle, we can see here. Then the fourth one, and look what happens. Widespread down bar. But look at the volume. It's already beginning to fall away. And in fact, we got a hammer candle with even higher volume underneath it. What is that telling us? It's telling us that the buyers are now coming in and pushing this price up. Perhaps it was at some significant level. Who knows? At the moment, we're not interested in that. All I'm trying to demonstrate to you here is if you read your candle patterns and together with volume, you're going to have a fairly good idea of what's going to happen next. And in fact, the price does in fact reverse. And again, this is a slightly longer example. This is the pound dollar on the 5 minutes. And I'm not going to talk too much about it because I know we're running out of time and I really do want to go to the live charts because I want you to see this in action. But you can go through this. This is in the book, by the way. So there's lots of these examples where you can see this is phase 1 in agreement, phase 2 sideways movement, in a bit of sideways and disagreement. Then you've got phase 3. You've got a nice little waterfall again with a rising volume, which is what you would expect to see. Phase 4, it stops. And then phase 5 again, it carries on up. And you see these patterns, you see this behavior in all time frames. So it doesn't matter whether you're a scalper, a swing trader, or a longer term trader. You are going to see this in all time frames. And we're just talking price and volume here. I haven't even brought in support and resistance. I haven't even talked about the candle patterns in any great detail. If you only did this, and I always say, if you only traded 2 candles, one is the hammer candle and one is the shooting star, you wouldn't, perhaps you'd have to sit back a little bit more often. And you used multiple time frames, I can assure you, you would be, your success rate would increase exponentially. And finally, on the 1 hour, this is the Aussie yen. And this is when price and volume actually keeps us out of the market. As I said, price moves up, price moves in congestion, and it before it breaks out. And again, volume will validate that breakout. And congestion periods are, if there is one quality that we all need to develop as traders, and that quality is patience, regardless of the time frame that you're trading. And it is the most difficult of qualities to try and develop, if you like, because we're impatient. We want to get in there, we want to trade. It's all terribly exciting, but actually, trading needs to be quite boring. And, you just have to sit there, and it's very hard. If you look at that, this is the hour chart. If this was your pair, you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. You've got 21 hours where the price did nothing. And that is not uncommon. There may have been a perfectly good reason why it was moving sideways for such a long time. But look at the volume. No one is interested. There's nothing out there to give this pair some oomph. The good news is it doesn't stay like that forever, but you have to learn to be patient. Now, let me just whiz that down and let me go to the charts, because there we are. Scroll back for more question to tick on. Right, okay. Right, I'll just go back to the Forex volume. This is actually This is just a demo account from Oanda. Your broker will give you, it's on MT4, and yes, I accept it will be your broker's volume. Now, I tend to use Oanda on a demo because I know their feed is very good. The quality of the tick data is good. I can't vouch for maybe some of the offshore brokers. It's a question of you'd have to download a few demos and just compare. But please don't try and make them match because the quality of a data feed will vary. You'll have sometimes you can have latency problems, but also it also depends on what your broker is allowing you. If you are on very restricted number of pairs, as I said, you really want to get a broker that will give you the best quality feed with the widest number of pairs. I don't even have all the pairs up here from Oanda. You could also just pay for a data feed. I'm using the MT4 platform here, but I also use the NinjaTrader. And for those of you who've come along to some of my other webinars will know that David and I use Kinetic, and that is just tick data. But you have to pay for that. But if you want to keep to the feed that is provided by your broker, and yes, it is the volume that is being displayed there, it's a bit of trial and error. It's not perfect, but nothing is. And as I said, you're really going to have to sort of try. Right, so that's that. I hope that answers that one. How do you use it? The arrows that you see on the charts, my charts at the moment, that's actually some pivots. And what they do is they help me define the areas of congestion. As I said to you before, volume price analysis is not just, it is price and volume, but it also encompasses support, resistance, candle patterns. So if you can identify on your chart what a price, how a market is behaving, a market mood, if you like, then in multiple time frames, then you're going to be an awful lot more successful. Now, what I've done here, because we were talking about the currency matrix, and I wanted to illustrate to you what I meant by isolating individual currency strength and weakness, and I'm just going to expand this out because the way I'm afraid I do cheat. And I just want to move the chat box out of the way. I don't know if it's interfering with you. Right. Here we are. Right. I use the currency strength indicator. And there are various currency strength indicators on the market. But essentially, what a currency strength indicator does, it does all the hard work for you, saves you having to look at hundreds of different charts. But each one of those lines represents an individual, please note the word individual currency. So, the lines I'm particularly interested in, and I really want to draw your attention to today, is this yellow line, which represents the British pound, and this sort of golden yellow line down here, which represents the euro. And what this does, and this is the hour chart, but again, you can use any time frame that you like. The process, if you like, the principle is identical. And on the hour chart, what this is telling me, it's telling me how an individual currency is moving, whether it's going up, down, whether it's strong or weak. And what I'm looking for, because currency pairs, if you like, move like a sine wave, they go up, they go down, they go sideways. I'm always interested in looking at extremes. And what this particular indicator does for me, it tells me when a currency, and I do stress the word a currency, is reaching an extreme. And let's stay with the euro because that's the one that most traders look at. And the goal down here, it tells me that in this time frame, the euro has been selling off and it has now reached a point where it is likely to reverse. But what is it going to reverse against? Excuse me. Is it going to be the dollar, or could it possibly be that the strongest move back for the euro could be in a different pair? And this is where the matrix comes in. And what you do very simply, as I said, you don't have to use an indicator like this. You can simply just have the charts. So what I've done here, I've just got 4. You can have 5, you can have 6. I think 4's enough. So I have the euro dollar up here. Next to it, I have the euro yen. I have the euro Aussie, and I have the euro pound. And by looking at the 4 pairs in which the euro figures on one side, and having looked at where it was relative to other currencies, I know that it is looking to turn back up. I can spot immediately whether it is, in fact, it's going to turn and where it's going to turn first, because it doesn't always turn in the most obvious pair. And getting back to what I said to you before about how the actual Forex market functions, in that you do actually have huge sums of money being exchanged and swapped. And to get back to the euro, those of you who follow these things, who perhaps read some of the financial press, the Chinese now have set up, not just the Chinese, other countries who want to move away from the US dollar, have set up swap lines with the yuan and the Brazilian real. Now, they may not go directly. They may actually have to sell some of their dollars. They may have to buy some euros and buy. So there's all this sort of web of complexity which is going on behind what you are actually seeing on your chart. And to get back to my currency strength indicator and my matrix, had I been looking at this earlier on, what would the one to me that stands out is the euro pound. And if I just expand that chart, as I said, price and volume, if we move back to this huge telegraph pole here of volume activity, what happened? The euro pound was moving sideways. It was stuck between these very 2 strong bands of resistance at the top, support at the bottom. My pivots were telling me that, it was basically in consolidation. You had a huge amount of activity came in, and what did the price do? It did nothing. It just stopped. It went sideways a bit more, and then you had this amazing price waterfall. And look at this. You had rising volume to accompany it. That is validating a move. Where does the price go to? It breaks through this particular support and resistance setup that I have. Where the lines are thicker, it just tells me that the support or resistance is stronger, if you like. But it managed to get through, but it pushed back up, moved sideways. That's hit resistance again. It's a bit up and downy, as we can see here. That's perfectly normal. Tries to rise again, doesn't, goes back to the next support level, and look at the volume. It accompanies it all the way down. And the next phase of this price action, well, I look over here. I know that at some point this is going to turn. I know the pound is overextended. I could go into, I also have a matrix for the British pound. And this is how you are constantly monitoring what the market is, what these individual currencies are doing in terms of individual strength and weakness. Where is that best represented, and how can I best exploit that? I happen to have the pound, the hour charts up, but you could have the 5 minute, the 1 minute. And in fact, the sell-off of the euro wasn't as strong against the US dollar. That is the obvious pair. The best trade was actually against the British pound. Let me just see if there's any more, because I've got some more charts. You have to have... I've run over time. Oh gosh, right, okay, I'll go back. Are there any, very, very quickly, are there any questions? Because I've got 3 more slides and that's it. Any more questions from anybody? Something I said that you don't understand? No? Okay, fine. I'll just go to the keynote back. There we are. And I've looked at the charts. The summary. Okay. Volume, price, support, resistance, candles. They are what I call your primary leading edge trading tools, indicators, because they give you real-time analysis. Your currency matrix isolates currency strength and weakness, and it tells you the true market sentiment. It tells you where that buying and selling is actually concentrated and focused. And this is something completely different, but I just wanted to highlight it to you. This is the chart of the FTSE 100 going back to 2004. I said to you at the beginning that volume and price has been the mainstay and at the heart of our family, and by family I mean myself and David. Our responsibilities to our family is to maintain our family's wealth and to build on that wealth, so we educate our children. And, we don't want to be caught on the wrong side of the market, because as Warren Buffett always says, your first priority in trading and investing is to preserve your capital. Because if you don't have any capital, you're out of this business. And I just wanted to highlight this to you. In 2007, around here, we actually liquidated our property portfolio and we liquidated our stock market holdings. We got out of the market. We knew things were not good. Then we had the financial crisis, which is still in some ways still going on. Through 2008, we sat out, we did nothing. In fact, we lived in Spain for about a year or so, which is fantastic. We just did nothing, and we did other things, and we studied, and we just did other things, and we waited and waited. And in fact, we went back into the stock market in 2009, and the thing and the one candle that prompted us to look more closely at moving back into the stock market is the hammer candle and the volume in 2009. We didn't actually get in almost immediately because it's not that easy. You have to wait for validation, and we wait, and we're still in this market now. This is how I use personally volume and price. As I said, it's been there for 17 years. I firmly believe that it's also available in the Forex market with tick data. You may not agree, but all I can offer you is I can offer you this book for free. It's free on Amazon to download. You don't have to pay a penny. Go and grab your copy now. If you don't agree with me, send me an email, send it back. I really won't be offended, but you do have to be quick because the offer ends tonight. And I know we haven't answered many questions on the chat, but if you do want to get in touch with me, you're more than welcome to email me at anna@annacouling.com. Go to my site, you'll find market analysis there, you can find commentary, you can find what other people have written about me, or you can follow me on Twitter, and at my site you can also catch up with my, if you want to see what I write on my Facebook pages to do with Forex and commodities. I'll just go back to the charts because I think that's about it. Right. Okay. Oh, thank you. She's put that from Maud. Thank you so much. Any more questions? Otherwise, I think we'll wrap it up there. I think we're just about in time. And let's look at just one final look at the euro-pound chart. And what do we see? Right? We see volume coming in, narrow spread up candle. That price, I call that stopping volume. That's now stopped. But we know that is probably going to reverse. Has it reversed on the euro dollar? No. The sentiment the positive sentiment in the euro at this moment in time, as shown by the individual currency strength indicator, is that there is more sentiment towards the euro, but against the British pound. But it's also actually moved up against the Japanese yen as well. Okay. Lovely. If you want to, if you need any more information about anything that I've shown you today, if you just send me an email and at anna@annacouling.com. Brilliant. Thank you. FX Street are going to call you today. You're more than welcome. Thank you. Thank you. Thank you. Thank you so much. I hope you enjoyed it.